Now I'm pleased to present one of our ERISA team members and the Managing Director of the Central Coast, John Nelson.
Great, thank you, David. So good morning, everybody. I'm going to talk to you today about IRA rollovers. So there's a new prohibited transaction exemption for advisors who work with IRA rollovers. It's Prohibited Transaction Exemption 2020-02. So let me start out with just a little bit of background. Why is the Department of Labor issuing a prohibited transaction exemption? So if you can see my screen, okay, in fact, maybe I'll go ahead and make this a little bit larger. Does that help, David? Okay, so here's a couple of quotes from the Department of Labor's prohibited transaction exemption. So this is not me talking. This is the Department of Labor talking. The first quote, "The decision to roll over assets from a plan to an IRA is often the single most important decision a plan participant makes involving a lifetime of retirement savings." So that's why the DOL considers this important. The second quote, also from the DOL prohibited transaction, "Financial providers have a strong economic incentive to recommend that retirement investors roll assets out of ERISA protected plans into one of the provider's IRAs." So you can see the Department of Labor is concerned about the conflict of interest that advisors have in terms of recommending proprietary products. Now, the effective dates here originally, Prohibited Transaction 2020-02 became effective February 16th, 2021. The DOL allowed a transition period until December 20th, 2021, during which it would not enforce the prohibited transaction rules, as long as you as an advisor were taking steps to comply with the Impartial Conduct Standards. I'll talk about that. Beginning 12/21, next December 21st, the full terms of the prohibited transaction were to apply. Now, this is hot off the press here. On Tuesday, the Department of Labor issued Field Assistance Bulletin 2021-02. And what the DOL has done is they basically have delayed enforcement of the rollover policy. So right now, what this means is that you can still act under the Impartial Conduct Standards, the best interest standard, on IRA rollovers up until January 31st, 2022. You have until June 30th now to come into full compliance with the prohibited transaction exemption. So specifically, part of the exemption requires that you include specific reasons. When you make a rollover recommendation, you have to include in writing the specific reasons why the recommendation is in the investor's best interest, and you have to provide that to them. You don't have to start doing that, though, until after June 30th now, but all the other requirements I'm going to talk about today become effective February 1, 2022. So we've got a little bit of time now to come into compliance with this. We don't have to comply right away by December 21st. A little bit of a delay here. Okay. So let's kind of space down now. And let's talk about why we need a new class exemption. What are we trying to address here? So the idea here is that many investment professionals regularly recommend either plan to IRA rollovers or IRA to IRA rollovers. Those types of recommendations are now covered by the prohibited transaction exemption. It also would include if you're changing from a commission-based account to a fee-based account and vice versa. Those transactions are also covered. What this exemption allows you to do when you make a recommendation on an IRA rollover, most importantly, it allows you to get paid. So you can receive compensation if you comply with the prohibited transaction exemption. You can get paid for the advice you provide. Compensation is defined very broadly. It includes commissions. It includes 12B1 fees, trails, sales loads, markups, revenue sharing, payments from third parties, all compensation. The exemption applies to SEC and state registered advisors, broker-dealers, banks, insurance companies, their employees, agents, and representatives. So it's pretty broad. But once again, the concept is if you make a recommendation to a client to roll money out of the plan into an IRA, or if you're recommending that they move from one IRA to another and you want to get paid, you need to comply with this exemption. Okay? Let's talk about some of the specifics now. Now, this is important. Back in 2005, the Department of Labor issued what was called the Deseret Letter. Okay? And in that Deseret Letter, they stated that advice to roll assets out of the plan does not constitute investment advice with respect to the plan. So in 2005, the DOL essentially said that IRA rollover recommendations weren't covered by ERISA. They've now said that they're not going to follow that advisory opinion, and they're grouping IRA rollovers now within the concept of investment advice under ERISA. So that's the big change right now. 2005, you could do this. Now you can't. Okay, so what does 2020-02 require? So the investment advice fiduciary must provide advice in accordance with the Impartial Conduct Standards. And I'm going to talk about that in a moment, what that means. Acknowledge fiduciary status in writing. And the DOL did provide a model fiduciary acknowledgement that I'll read for you in a moment. Describe in writing the services to be provided. Describe in writing any material conflicts of interest. What that basically means is you have to describe how you make money if the recommendation is accepted. And then document the reasons that a rollover recommendation is in the best interest of the investor and provide that documentation to the retirement investor. Now, you see, I put some of this in dark. So, because up until January 31, under the late effective date, all you have to do is the top one, provide advice in accordance with the ICS. Beginning February 1st, you have to comply with the next three of these requirements, okay? You have to acknowledge fiduciary status in writing. You have to describe in writing what you're going to do, and you have to describe your conflicts of interest in writing. The last one here, document the reasons the rollover is in the best interest of the retirement investor, provide that documentation to the investor. That's not going to be effective now till July 1, 2022. Because the thought was the DOL felt that too many people were having a hard time getting systems ready to provide that specific documentation. So they've given you a delayed effective date, but only with respect to that last one. So just to recap, you've got to comply with ICS standards right now if you're in the IRA rollover business. Beginning February 1, you have to comply with these next three. Beginning July 1, you got to comply with the last one. Okay. Okay, so there's a question that came in asking whether the exemption applies to plan-to-plan rollovers, participants' prior employer plan into their current employer plan. The answer would be yes, but I think what's key there is how you're getting paid on that. If you're the advisor on the old plan, or you're also the advisor on the new plan, is your compensation level between the two plans? But I think conceptually the answer is yes. This would apply to a plan-to-plan transfer as well. Okay. All right. And I want to mention that if your compensation is level, if your recommendation doesn't affect what you get paid, you're getting paid 50 basis points before, 50 basis points after, then you're going to be okay. It's just if your compensation is affected by your recommendation that we've got to take into account this prohibited transaction. Okay. Now, what I'm putting up on the screen now is the model notice of fiduciary status. Now, most of you probably won't actually provide this detailed type of acknowledgement, but I want you to at least see what the DOL recommends as the model so you can kind of get a feel for what the Department of Labor wants to see in terms of your acknowledgement of fiduciary status. Now, let me back up again and remind you that if you're in the IRA rollover business and you don't think you're a fiduciary, I'll give you some examples in a minute of where it might be an unsolicited rollover, or you might just be providing education and not advice, so you're not a fiduciary. But I think it's a pretty thin line. I would not be comfortable being in the IRA rollover business without at least recognizing and acknowledging fiduciary status. I think you're pretty much a fiduciary for doing this. But here's what the model disclosure says. When we provide investment advice to you regarding your retirement plan account or IRA, we are fiduciaries within the meaning of ERISA. The way we make money creates some conflicts with your interests. So we operate under a special rule that requires us to act in your best interest and not put our interest ahead of yours. Somebody wants to describe this to me, like it's the idea, like if you go to a car dealership, if let's say you go to a Ford car dealership, well, that Ford salesman is probably going to sell you a Ford, all right? That may be suitable for you, but it may not really be in your best interest. So if what you're doing in connection with the IRA rollover business, it's got to be in the client's best interest. It can't be in your best interest. Under the special rules provisions, we must make a professional standard of care, meet a professional standard of care when making recommendations, never put our interests ahead of yours, avoid misleading statements, follow policies and procedures, charge no more than a fee that is reasonable for our services, and give you basic information about conflicts of interest. So that's the model acknowledgement that you're going to have to provide. You don't have to provide the model language, but you have to provide an acknowledgement to the client that you are acting as a fiduciary. Okay? All right, let's continue on. So what do you need to be doing right now? So right now, you need to be complying with the Impartial Conduct Standards. The Impartial Conduct Standards include 3 elements. The first is the best interest standard, namely, the rollover recommendation must be in the IRA owner's best interest. Do not place the interests of the advisor ahead of the investor. It does not require that you identify the single best investment, but it does require that you make a recommendation that's in the in the retirement investor's best interest. Sorry about that. Reasonable compensation. You can't charge more than reasonable compensation. Now, what's interesting here is that you're responsible as the advisor for determining that your own compensation is reasonable. Now, if you think about this, if you work in the retirement plan business, who's responsible for ensuring that retirement plan related fees are reasonable? Well, it's the employer, the plan sponsor, not you as the advisor. But in the IRA context, you're responsible for determining that what you're charging is reasonable. Okay? Reasonable compensation does not mean lowest cost. Okay? But you've got to establish that what you're charging is reasonable. What's reasonable? Factors would be the services you're providing, the market price of those services, the complexity of the product, and the scope of monitoring that you provide. All right, so you have to establish your fees reasonable, use your factors, and how you do that. And then the third aspect, of course, is do not make misleading statements. So that's what you have to be doing right now, okay? Now let's talk a little bit more about this idea of the best interest standard. So how do you demonstrate that your rollover recommendation is in your client's best interest? Best interest factors typically include the costs associated with the options under the plan and the IRA. Now, I'll tell you, if it's more expensive to the participant in the IRA than it is in the plan, that's okay, but you better be able to demonstrate why it's in your client's best interest to pay a higher expense, okay? You need to take into account the range of available investment options under the plan and the IRA, okay? That would be a reason why the recommendation might be in the best interest. And then the individual circumstances and the needs of the retirement investor. You know, your client needs monitoring. Your client needs financial planning. Your client needs all their accounts in one place. So things like that. That's how you demonstrate best interest. Okay, a question came in. Have you reconciled these requirements against those of the SEC's Reg B1? There are similarities, but there are differences. So the fact that you're complying with the Reg B1 and your CRS form, that's not going to be enough because there are different standards. You have separate compliance here. There is some alignment between the two, but they're not identical. Okay. Okay. So how does the advisor determine what the fees and expenses associated with the plan are? Because remember, part of what you're doing in terms of best interest is you need to know what is your client paying in terms of fees and costs under the plan, so you compare that to what they're going to be paying in the IRA. Okay. Now, the best way to do that every participant each year gets a fee disclosure from the plan sponsor. It's called the 404A5 participant fee disclosure. So the best thing for you to do is to ask your client for a copy of the fee disclosure for the plan. And that'll tell you all the fees that your client is paying as a participant inside the plan. Get the fee disclosure. Now, it's surprising to me, but I talk to other advisors and they tell me that in most cases, the participant doesn't know what the fee disclosure is. They don't have a copy of it. They can't provide it. So what do you do then? So what the DOL says is that if the information is not available on the expenses in the plan, then you can make assumptions of expenses based on publicly available information. So what does that mean? Well, it means the most recent Form 5500. So you download a copy of 5500 for the plan. You can see what the investments are. That'll tell you what the investment expenses are. It won't necessarily tell you, though, what other plan-related expenses are. It won't tell you what the costs of administration are, things like that. But it will give you some information. But then the other thing that you can rely on is what they call reliable benchmarks on typical fees and expenses for the type and size of the plan at issue. Okay, so at RPAG, one of the things that we'll be putting together will be a benchmark for you that you can use for plan assets, based on a plan size, this type, these are typical fees. So once again, the best source, though, is the fee disclosure to the participant. If you can't get that, then you can make assumptions in terms of comparing fees and costs, the current plan versus the IRA rollover. Now, if you use assumptions, you have to explain to the investor what the limitations on those are. Okay, I'm using assumptions. These are the limitations. Let's see another question came in. My experience is that our clients don't want to be bothered looking for it online, or B, have tried to find it very difficult. Yeah, so that's a question that came in, right? So the fee disclosure statement, sometimes it's hard to get. If you can't get it, then you can make assumptions based on the 5500 for the plan or benchmark data. Okay, all right. Okay, now keep in mind that you're only subject to the prohibited transaction exemption if you're providing advice. So I mentioned earlier, if you're providing education, and I'll talk about what education is in a moment, you're not covered by this. But if you're providing advice, then you need to comply with the exemption. So what is fiduciary investment advice? So here we go all the way back to 1975. Okay, 1975, the Department of Labor established a 5-part test. Okay, under the 5-part test, rollover recommendations will be considered investment advice if the 5-part test is satisfied. So the first one is you're making recommendations to the plan or the IRA owner as to the advisability of investing in purchasing or selling securities or other property. Okay? So you're making a recommendation. That's the first part. You're providing recommendations on a regular basis. I'll talk about that in a moment. Pursuant to a mutual agreement or understanding that the advice will serve as a primary basis for investment decisions by the IRA owner, and the advice is individualized based on the particular needs of the IRA owner. Now, all 5 elements have to be met. So all elements of the 5-part test must be satisfied. But I made a note here because I think as a practical matter, if you're found to be providing advice on a regular basis, okay, a regular basis, that's this first one up here on number 2. If you're doing that, then I think you necessarily meet all the other requirements. So regular basis, I think, is very key in determining whether or not you're providing advice. Now, once again, the only person that wants to go down this road is the person who says, well, I'm in the rollover business, but I can't be a fiduciary. My broker says I can't, or I don't want to be a fiduciary. So the only way to get up underneath this is to demonstrate that what you're doing isn't investment advice, okay? But as I said, I think probably 99.9% of you in the rollover business are providing advice. This is a facts and circumstances functional analysis. So the fact that you may not be a you may not be a fiduciary under the fact that you may not be a fiduciary under other laws, such as securities or insurance, is not determinative. And also, you can't avoid this by contract. So you can't do all these things, but at the end of your service agreement say, I'm not acting as a fiduciary. No. There's an old saying in law, if it walks like a duck and quacks like a duck, it's a duck. So regardless of what you try to say in the contract, if you're acting as a fiduciary, you're going to be a fiduciary regardless of what the contract says. Okay? All right. Let's keep rolling here. So, checklist for advisors. As I said, are you providing fiduciary investment advice? If you are, then you need to apply for the exemption. So are you providing regular basis mutual understanding versus a single discrete instance of rollover advice? And then let's talk about education versus investment advice as well, okay? Okay, I think there's basically three types of transactions in the rollover rule. There's the unsolicited, where somebody calls you, will you help me with this rollover? There's where you're just providing education, and then there's the recommendation. As I said, I think probably 99% of the transactions, IRA rollovers, are going to fall here. Okay. This is the only one, though, that's covered by the exemption. If all you're doing is education, unsolicited, then you don't need to worry about all these rules. Okay. Hope that makes sense. So what does regular basis mean? Not all rollover recommendations are fiduciary investment advice. Parties can and do enter into one-time sales transactions in which there is no ongoing relationship planned or anticipated. So when is rollover assets from a plan to an IRA not considered on a regular basis? So I mentioned just a single discrete instance of advice, roll assets out of the plan to an IRA, that's not going to meet the regular basis test. For example, a participant purchases an annuity based on a recommendation from an insurance agent without receiving ongoing advice. Okay, that's probably not regular basis. Participant is helped with the rollover and expresses his or her intent to direct their own investments in the IRA without any expectation of entering into an ongoing relationship with you. That's probably not regular basis. Trail commissions in and of themselves don't cause it to become regular basis. It really depends on whether you're providing ongoing advice to the investor. If you're not, then you may have an out, okay? Now, have you been providing advice to the individual regarding his individual directed account under the plan? Okay, so ongoing advisory relationship with the plan does not entail advice to individual participants. So if you're the advisor on the plan, that doesn't necessarily make you an advisor to the participant unless you are in fact providing participant level investment advice, okay? So that's what regular basis means. And mutual understanding, the idea is mutual understanding is a primary basis, that what you tell the employee, what you tell the participant in your recommendation, that will be a primary basis. The actual language in the regulation says that your investment advice will be the primary basis, but the Department of Labor has interpreted that over the years as just a primary basis. It doesn't have to be the primary basis. So as I said, written disclaimers are not determinative. They may be considered. So if you do have that disclaimer in your service agreement that you're not the fiduciary, you're not going to be providing ongoing advice, that'll be considered, but it's not determinative. So the Department of Labor is most concerned by what it perceives as the bait and switch problem, okay? The bait and switch problem, where the advisor promotes that they will act as a trusted advisor to a retirement investor and then disclaim fiduciary status and fine print in the governing documents. Okay, so that's not going to work. The general trend in the financial services industry does seek to assist individuals with a range of financial and life choices over a period of years. So care will be required to appropriately structure, market, and document arrangements where fiduciary status is not intended. So see, this is why I'm saying that when I said that I think probably 99% of you are fiduciaries, so I think most of you are probably doing this type of work. You're working with your clients to assist them with a range of financial and life choices over a period of years. I think that makes you a fiduciary with respect to plan and IRA assets. Okay, let's see if there's any. Okay, good. Okay, continuing on now. Okay, now let's talk about this, okay, because remember I said if all you're doing is providing education, that's not advice. So what is education in the eyes of the Department of Labor? So now we're going to go back all the way to 1996. So in 1996, the Department of Labor issued what they call Interpretive Bulletin 96-1. And what that did is that identified 4 categories of information and materials that do not, in view of the department, constitute investment advice. Okay, this is education. So the first one is plan information. So if all you're doing is providing information about the benefits of plan participation, the benefits of increasing your contributions, the impact of pre-retirement withdrawals on income, the terms of the plan, operation of the plan, that's not advice, that's education. So here, this is key. The information materials described above relate to the plan and plan participation without reference to the appropriateness of any individual investment option for the participant or beneficiary. See, the key here is what you're doing, you're providing plan information, but it's not individualized to the participant or your client. It's just generic plan information. That's not advice. The next one then would be general financial and investment information. So once again, look at the stuff, if you're providing general financial and investment concepts, such as risk and return, diversification, dollar cost averaging, compounded return, tax deferred investment, historic differences in rates of return between different asset classes, stocks do this, bonds do that, effects of inflation, estimating future retirement income needs generically, determining investment horizons, assessing risk tolerance. The information materials described above are general financial information that have no direct relationship to investment alternatives available in the plan or to. So once again, you're not individualizing the information providing, it's general. Once you start making it individualized to your client, then you cross over from education to advice. Okay, 2 more categories. Let me go back up here. Asset allocation models. Okay, so if you're putting together pie charts or case studies that provide models of asset allocation based on hypothetical investors with different time horizons and different risk profiles. So you've got models. This would be, if you're an aggressive investor, this would be an allocation model. If you're a moderate aggressive, moderate, so just doing asset allocation models, once again, that's not personalized. So that's not going to be advised. And then interactive investment materials, questionnaires, worksheets, software, similar materials which provide the participant, you give the participant the means to estimate future income needs. You give the participant the means to assess asset allocation. You give the participant materials so the participant can make the decision, then that's not advice that you're providing. Okay. So these 4 categories of investment-related information are education, not advice. So it doesn't matter how often you do that. And it doesn't matter whether you do that on an individual or group basis. So if your thought is, I'm not a fiduciary because all I'm providing is education, then take a look at Investment Bulletin 96-1, because that's what you need to comply with to have that out. Okay? Okay. So let's talk about some specifics here now. So remember, the rollover recommendation has to be in your client's best interest. So what are some of the factors to consider in determining whether or not your recommendation is in your client's best interest? Here's some that I have in mind. The first one would be, your client has retired or terminated employment. Can he or she leave their money in the plan? Sometimes plans are drafted and they say that your only investment option, when you terminate, you have to lump sum out of the plan. Now, generally, the participant whose vested account balance exceeds $5,000 can postpone distribution until the later of, under the plan, normal retirement age rate 62. So the plan can't force participants out of the plan if their account balance is more than 5,000. Look at the range of investment alternatives available in the plan in the IRA. It might be that the plan has very expensive investment options. The plan might have very limited investment options. Your client might want to pursue an ESG investment strategy, but the plan may not have ESG investments options. So these are things to look at. Compare the fees and expenses under the plan. Now, I think this is the big one, okay? Because once again, I think if you're rolling your client out of a more expensive arrangement to a less expensive arrangement, that's pretty easy to demonstrate best interest. If the client's going to be paying more in the IRA, then you need to go through these other factors to demonstrate. So compare fees and expenses. One thing you need to figure out is, does the employer pay all or some of the fees and expenses? And, I always kind of still laugh because sometimes, you ask your participant, well, what does your 401k plan cost you? And they'll look at you and they'll say, well, it's free. It doesn't cost me anything. That's why people are supposed to get those fee disclosure statements, because it does cost something. There's expense ratios. There's might be revenue sharing. So the fact that nobody's writing a check, of course, doesn't mean, of course, it's free. But here's the key. If the IRA fees and expenses are more, what added benefits justify those higher costs? Okay. So you've got to focus in on costs when you're doing IRA rollovers. Compare the permitted forms of distribution under the plan of the IRA. Now, there's still a lot of plans out there that the only distribution option out of the plan is lump sum only. You can get a single cash distribution, but that's it. Now, all plans that I work with, I tell employers, check the box that allows employees, former participants, to do partial distributions out of the plan. Just build in some flexibility for them. Don't make them take their money out all at once. But still, there's a lot of plans that have that lump sum option as the only distribution option. So look at that, because if you can't take periodic installments or partial withdrawals, that might be a reason to roll out of the plan into an IRA, because then you can tailor withdrawals to your client's needs. What about penalty-free withdrawals? Okay, the rules are a little bit different for IRAs and plans. If your client terminates employment after age 55, they can start taking distributions from the plan before 59 and a half. If they terminate after 55, they can start taking installments and not pay the 10% penalty. That exception isn't available to IRAs. But IRA distributions, first-time home buyers and qualified education expenses are available without the penalty. That's not available in the qualified plans. So look at penalty withdrawals. Roth conversions. Does the plan allow conversion of non-Roth funds to an internal Roth conversion? And I might add, there's been a lot of talk about the, mega Roth inside of the 401k plan, the idea to make an after-tax contribution to the plan. You immediately convert that to Roth. Then you get the tax-free build of the earnings. Part of the Biden infrastructure plan, the Democrats have to find ways to pay for that. One of the ways they're planning to pay for that is to take away that mega Roth conversion provision effective 12/31/2021. So I just mentioned that as a comment, but that's probably going to go away. So if you haven't put that in place for your clients, that may not be available going forward. Think about the MRD rules, protection from creditors and legal judgments. Is your client a professional, a doctor or a lawyer? If so, the qualified plan offers better protection from judgment creditors than the IRA does. Does the plan have employer securities? Especially if it's not a privately held company, then you probably need to stay inside of the plan. Otherwise, you need to find a self-directed IRA custodian that would hold that type of asset. Does your client want to invest in real estate? Things like that. That would argue in terms of IRA. So these are factors to take in mind in terms of demonstrating this in the client's best interest. Now, here's another thing I want you to be aware of. So the Department of Labor did release a consumer-focused guide to help retirement investors better understand their rights and roles of retirement investors. The guide includes a list of questions retirement investors should ask their advisor. So I would suggest you download from the DOL website a copy of this consumer guide so you can see the types of questions that your client may ask and you're prepared to answer those questions. So for example, here's the first one. Are you a fiduciary under the federal laws specifically applicable to retirement accounts? Will you be acting as a fiduciary when you give me investment advice? Are you complying with the DOL's exemption, PTE 2020-02? If you're not relying on an exemption, are you relying on another exemption, or do you believe that you do not have any relevant conflicts of interest? What fees and expenses will I be charged? Will you give me a list of those fees and expenses and explain what I pay for? Do I pay all of them directly, or are some of them taken out of my investments? What conflicts do you have in making investment recommendations to me? Do you or your firm get paid from any other source in connection with my business with you? Will you give me a written statement describing the payments I'm going to be charged? Are there any limitations on investments you'll recommend? If so, what are they? Under what circumstances will you monitor investments? And when will you make recommendations for changes? Why are you recommending I roll my money out of my current 401k pension or IRA? Okay. So these are the questions that DOL is telling investors they should be asking their advisor. So take a look at that consumer guide, download it. I think there's some good information for you. Okay. Now, I want to talk a little about what Retirement Plan Advisory Group is going to do going forward to help support you in this role of business. So I want you to understand that we're right now working on enhancements to support how you deliver your recommendations. This will be a framework to help with distribution decisions and investment strategy methodology. Now, there'll be a questionnaire for you to complete, help complete for you to know your client. We're putting together a plan versus IRA comparison chart for you. That would be a client-facing document. We're mining data on our database of plans and creating benchmarking for plan information. So if you're not the advisor on the plan and the A5 fee disclosure not readily available, we'll have benchmarking data you can use for assessing and comparing fees. We've put together a rollover acknowledgement, and I understand disclosure that the client would sign. And we're also putting together a supervisory dashboard for your broker dealer to use for annual reviews. All that's in process, all that's coming and is in work right now. That's how we'll support you in this business going forward. Okay. So to kind of wrap things up here, PTE 2020-02 allows advisors to provide investment advice to receive compensation. So if you're providing advice, you've got to comply with the exemption to get paid. Why is it important? It's important because the DOL withdrew the Deseret letter it issued in 2005. Because the Deseret letter, remember, said that advice regarding rollover is not fiduciary investment advice. That's been withdrawn now. So that's why we have to have this the PT exemption. The DOL now takes the position that an advisor may be a fiduciary when he or she gives advice to roll assets out of the plan and receives compensation for those assets in the rolled IRA. So that's what we're talking about now. Okay. Now, let me just go back real quick and just summarize for you again the effective dates that we're talking about. I'm going to roll up here to the top. Okay. So effective dates. So what do you need to be doing right now? So between now and January 31st, what you have to be doing is complying with the Impartial Conduct Standards. So that's best interest, reasonable fees, no misleading statements. That's what you need to be doing right now. Beginning February 1st, 2022, you need to be making your written acknowledgement of fiduciary status, written statement of services. And then July 1, 2022, you need to be including the specific reasons the rollover recommendation is in the investor's best interest. Okay? There are a couple of questions that came in. Let me take a look here. Yeah, so the question came in. One of the largest record keepers that also has a big rollover practice recently told a sponsor in a direct relationship that they will be amending their contract if the sponsor wants them to function in a fiduciary capacity. Now, this question doesn't say who that large record keeper is, but I do know that their name starts with an F. Okay. So basically, Fidelity is in the rollover business, and they recognize now that when they talk to a participant about rolling out of the plan into a Fidelity rollover IRA, they're acting as a fiduciary. So they are going to take that on, but they're going to provide. So they're changing their processes and strategies so that they can comply with the exemption. So Fidelity has said they're going to get into the IRA rollover business as a fiduciary. That's correct. Question we always ask, will the deck be made available following the presentation? Yeah, the answer is yes. The deck will be available in this webinar is being recorded as well. Okay.
Yes, thank you so much, Sean. And thank you everybody for attending today's webinar. We really appreciate your presence and we hope you have a great day. Take care.
Okay, thank you. Bye-bye.